All right, welcome to Module 8, the final lesson in how to buy your first investment property. In this module, I'm going to introduce a bit of everything we've covered: market analysis, deal math, financing, management, and we're going to talk about scaling it up to larger multifamily properties and partnership-based investing. So this is where the game kind of changes. You go from owning rentals to kind of owning businesses. You go from collecting rent to building generational wealth. In this game, scale matters. Owning a single property is great for learning. That's where I started. Owning several creates cash flow stability. Also, where I went after, right after I got my first one, I got another, and then I got another. But owning multifamily deals with partners creates real leverage and efficiency and true wealth, right? That's why most people eventually make their way there. When you own a 10-unit building, one vacancy isn't just it's dealable with. It's not catastrophic. It's 10% instead of 100%. Maintenance is centralized. Management actually scales, so your property management fee goes down as a percentile, and financing is often more favorable. Honestly, lenders view it totally different. They view multifamily as an income-producing business. In fact, the way they even do the mortgages is different. The amortization terms are usually a lot longer. You can get up to 40-year amortizations. And that's just a different beast altogether. Multifamily is the bridge between being a landlord and becoming an investor, right? The math behind multifamily value is different as well. With single family homes, values based typically on comparables, right? When you deal with a real estate agent, like the way that you figure out the price is often comparables, right? Multifamily value is based on income. It's based on the business performance. The formula is very simple but powerful. So you want to memorize this. Value in multifamily is straight up net income, so net operating income, NOI, divided by the cap rate, right? And you can figure out the cap rate in any market by just Googling it or ChatGPTing it. If you increase the income or you reduce the expenses, you directly increase the net value of the property. In that way, you're in control of the value creation. So, for example, you buy a 12-unit building producing $120,000 of net operating income at a 6% cap rate. You do the math. Net worth of the company, or net value of the business, is 120 divided by 6%, which equals $2 million. So if you raise the rents and you optimize the expenses, increasing your NOI to $132,000, the value jumps to $2.2 million when you divide that out. That's a $200,000 gain without touching the market. We don't need to see comparables, right? And this value is recognized by banks using the exact same math. No guessing. That's the magic of multifamily. You create appreciation through performance, not luck. And when you're making this jump from solo investor to general partner of a real estate business, most investors kind of hit a wall here. So that's why it's a new kind of type of education required. Because people hit a wall when they try and make the jump. And that's what I had to do. So what I'm learning, right? I'm going into the learning curve of a new asset class. You'll run into things like not enough capital or not enough ability to borrow, things that it's very difficult to go down this path buying alone, right? That's where partnership structures also come in. So this is a very introductory overview of what can come if you're interested in learning more about it. But there's really two ways that people scale as you get into the bigger asset classes. One is joint venture agreements, which is two or more parties own a property together. Everyone has a clear role, usually an active role, structured as like a 50-50 kind of deal most commonly. Or what's more common with like multifamily is actually, and the big deals, is limited partnerships. So there's a limited partners and a general partnership structure, and this is a model used in most large multifamily deals. The general partner is the operator. This is the person who finds the deal, secures the financing, manages the asset, manages the property managers. And then there's the limited partners. So I actually started there. I was a limited partner in a deal. So I just put up the money because I wanted to learn about what it's like to be in the deal and get education, essentially. So limited partners are just investors. They provide capital and they receive returns, and they have a share in the profits. But they don't have they have a limited liability, and they have no day-to-day management, so they're not making decisions by any means. As a general partner, your job is to protect capital, protect the asset, execute the business plan which is laid out, and communicate with transparency to the limited partners. For the limited partners, this module provides true passive investing. So if you're actually interested in passive investing, that's what a limited partner is. They don't have an active thing they're doing. It's almost like buying a REIT in that sense, except for REITs are public companies most of the time, and they're liquid. For the GP, it allows scale though, right? So the general partner, this is the step that allows you to scale into the larger assets, is getting limited partner investors to do it with you. And you can still maintain control and operational excellence if that's what you're really good at. But before you can really become a general partner, you really need to build trust before you can raise capital, is what I think anyways, right? So typically you start on, it all starts with, that's why I made this course. It starts with buying your first investment property and managing it, right? Whether you're managing a manager who does it, but having a property, like I've had rental properties now for 17 years almost. So you learn these basic stuff, and then the next step is you build trust and competence and education. You've educated, then you start to become, maybe I could be a general partner, right? Yeah, because raising money is never just about asking for money. It's about building trust, demonstrating competence, and creating alignment with numbers and vision, right? So here's how you can do it ethically and professionally, as far as I think. First is build a track record. Take a course like that you're taking right now about how to buy your first investment property. Go buy your first deal, get it managed, get it renting, start paying down your debt, and wait while it appreciates and goes up in value, right? Do things like take education, do courses like this, but many of them get lots of interpretations. Buy books on real estate, create content on real estate like this course. And it kind of proves that you know what you're doing, right? Share numbers, share about your deals, and just be consistent. These are kind of the things that I think are required when you're starting to raise capital. And when people can see that you operate with that kind of clarity and integrity, capital can start to make its way to you, right? Money flows to structure and certainty. In real estate, people get real estate because it's stable. When you create both, you're never going to have to chase capital. You can protect money first and then grow it. That's what I think the order is. Number one is protect the money, right? Somebody gives you 50 grand, protect that 50 grand, and then also growing the money, right? First order is to not lose it though. And that's what this is all about. So some of the key skills you need to master to succeed at the level of multifamily operator are things like you have to have a pretty deep understanding of underwriting, so debt, being able to forecast income, expenses, and returns with precision. So you want to be really skilled at stress testing, so sensitivity analysis, understanding vacancy rates. What happens if the interest rates change or move a little bit? How do you really structure the maintenance program of the property, right? So make sure you have a really strong asset. And just asset management, the skill of asset management. That's why I think it's not the worst if you are in a city or a place that you can buy real estate and find cash flow positive properties. Managing your first one is not the worst. I don't think it's scalable, but you get to learn about asset management, right? You're the CEO of a little business, a little building, or a little house, right? You set the budgets. You optimize the net operating income. You track the monthly performance. Another main skill that comes out, especially when you get into the bigger assets and start having partners, is investor relations. So I have a few partners, and I do every 6 months I do an annual report or a semi-annual report to talk about the performance of the property. What are the renovations that we're doing? What's the maintenance that we're doing? Have we increased the rents? How much debt did we pay down? And I have a little templated email that just covers everything that we did, what the returns are for the property, how things are going, what's our current strategy, which is all kind of in alignment with the original strategy that we started with. But investor relations, communicating regularly, honestly with partners, quarterly updates, financial statements, photos, progress reports. That transparency is what creates trust and longevity. So in terms of how I evaluate the multifamily deals, when I look at a 10 plus unit building, I start with kind of 5 questions. So always, is the market growing? Population, jobs, income, very similar to how we do just one property, like a small deal, right? Same idea. Does the property cash flow from day one? Same idea whether I'm buying 1 door or 100 doors. What's the upside? Is there some way I could add value beyond what's going on right now? Like a way to bring the value up or raise the rents or find a better use for the space? Or is there a renovation that's just looming where I can put in a renovation for $10,000 and increase the rents of 10 units by like $100, then if you do your your NOI statement, your value equation, you see that you can make a lot of money up front by just doing some basic renovation work. What are my risks? What are the downsides, right? Vacancy risk, repairs, regulatory risks. And then of course, the last thing I'd say is what's your exit strategy? What's the strategy at the end? Refinance, or are we selling this thing in 7 or 8 years? I like to refinance because then you don't actually pay taxes. You don't have to sell. You can just get your money out without having to actually trigger an income. Anyway, that's it. These are all personal decisions that you make with yourself and with your investment partners. The last thing I'll mention in this intro video is about scaling systems and mindset. So scaling up isn't just about building a bigger building. It's about better systems, more discipline, and just a different mindset. So you'll need to standardize a lot of things, right? Your deal flow pipeline, your relationship with agents and brokers, and sometimes directly with owners of buildings, your underwriting templates, due diligence checklists, monthly reporting systems, property management oversight structures. You really have to start thinking like a portfolio manager and an asset manager, not like a landlord. And that shift in identity is kind of what turns a small portfolio into a investment company, right? So in conclusion, bringing all this together, you've learned how to find strong markets, run numbers confidently, finance strategically, build a power team, negotiate professionally, right, and make offers, which again, just make lots of offers. You learned how to manage properties, about the property management and the importance of growing your income. And now a little bit about scale through partnerships and what it looks like to go into the bigger assets. This is a blueprint I used to grow from a single property in Chestermere to a portfolio of cash flowing assets across Canada. And now as I go towards multifamily ownership. So your next step is really to decide where you want to go from here. Maybe that's buying your first duplex and following this course to buy your first deal. Maybe it's partnering on a 12-unit deal as a limited partner with someone like me. Maybe it's staying in our community, joining a community of investors and operators and just learning more, continuing your education journey. And that's what your next step is. Wherever you are, keep learning, stay disciplined, and focus on cash flow and relationships first. Because real estate isn't about speculation. It's about freedom, stability, and impact. In closing, and my final few calls to action for you would be, number one is if you found this course valuable, engage with the course and go buy a property, and engage with the community here. Ask questions and share your deal breakdowns. Share market updates yourself, and the behind scenes process of what you're going through. Because this is a place to learn, connect, and grow together. Number two would be take the next course, right, on conducting more detailed financial due diligence and when analyzing a rental deal. So I share the full master Excel file in that course, and I go through each tab in detail. And the tab's there for download, so you can do more advanced analysis when you're doing your process. Number three would be take the other next course, which is on multifamily deals, where I share also financial templates and analysis for multifamily investing. So it's another detailed Excel template where I go through where it's just more robust, and I can go through all the nuances and how to split up the return structures between limited partners and general partners, right? There are other things that have to get included that are different than when you're just buying a duplex or a triplex by yourself. So those are the calls to action I have for you. I'm Brad. Thank you for being a part of this journey. I'll see you inside of the community.